Hello, Warriors. Everyone should have had a good day, good 24-hour period. Alexander, how are you? Bran, Shahab, Mike Bergman, how are you? Sinatra, Mary, Alexander, how's it going, everybody? So just take a look around and take some victory laps. Love victory laps, don't you guys?
Actually, I hate victory laps.
There's anyone
it's ridiculous. It's ridiculous because people that take victory laps usually are just that they're the ones that will not accept the fact that they have taken losses too. So,
well, I don't know. There are a lot of great athletes that take victory laps that have lost as well.
Yeah, that's a good point.
Why not relish it a little bit? I'm not saying do cartwheels.
Yeah,
and then go feel.
In trade, it's usually the people that take losses and they won't accept the fact that they've taken a loss because they have a hard time admitting it. But when they when they make money, they're like, "Woo, look at me go."
Yeah, I know. Brag,
Twitter. And here's the other thing. I got to say this. When you're trading, there's so many ways that everybody trades the market. Not everybody's going to participate in a move. I can I always go back to I can lead a camel to water. I can't make it drink. When you're dealing in the markets, there's so many different ways to trade. It stinks when you participate in a move and somebody didn't. And there's a lot of times where I miss moves and because it didn't fit what I was trying to do. And I've missed big moves many times, obviously in my career. And when that happens, I don't like to make, or if I capitalize on it, I don't like to make people feel bad that they didn't.
Yeah, you mean like the guys on Twitter that said, I called this. I hope you caught it. When they I know you missed it. I know you missed it.
Like, look at you, you idiot! You missed it. No, they just didn't see it. It didn't fit the way that they're trading the markets at that moment.
Well, I sure fit and clicked for everyone listening to us the last 2 days that the dollar had more left in it, and cable leading to the downside, and Aussie even looking worse. So I mean, this, I said up here 70. Huh? Yeah.
You nailed that one, Dale.
Yeah. So maybe
I'd pay to see you do a cartwell.
I'd pay
throw
to
out
see you
my
do a
bag.
Cartwheel. I would pay that. I would pay money to see you do a cartwheel.
It would look more like a Western roll. Okay, if you know what that is. Anyway, so nice dollar move, and maybe we're getting close in the gold. I don't know. I mean, 1810 was an area I was looking at, and there's that 1780 level. That's a 61.8. But I think this is, this flush is going to be an important buy point. And maybe, here's something that we talked about last week, and it held, Blake. Remember the copper a couple times it held here? I don't think copper is going to hold this time. And I don't
know. I mean, that's one of the things that when you look at what's happening in copper, we were just having this conversation in the ForexAnalytix chat room just a moment ago. She was like, well, look at these moves in bonds. How is it the stock market hasn't moved? And I mean, that's kind of questionable for everybody, right? But you see China, or you see copper starting to break down like that. And I did an interview with Helene Meisler, right?
Yeah.
Her husband,
Ken Morrison.
He's
the father of Van.
Yeah, right. I've known Ken for a good 12, 13 years or whatever, and he was like, hey, look at the Baltic Dry Index. It tells a much different story than
about
what everybody's saying about China's reopening, and copper rolling over is just kind of confirming that too. And maybe these are the catalysts that the market needs to see to suggest that maybe China's not all made up like that, or made up to what supposed to be. I don't know.
Anyway, so far it's a beach ball, and Pretty good failure in S&Ps, even though they closed higher on the day or not much lower. And, to me, it looks like for sure under 4,000, it's at 3,800 in a hurry. And, we're not there yet, and it could still, break out. But I think copper is perhaps a tell about economic growth. And, that's the next part of the narrative is even, and we have Mark Chandler here today. I'm going to ask about some, BOC, why they're pausing. But the next part of the narrative is not rates, it's growth and lack of growth. And that's what copper's starting to say right now about the global recovery. And that's when you'll get the earnings revisions to the downside. So, the rate thing is maybe not going to be as important as slowing growth, and the market will be hoping for the Fed to pause, and they don't. And that's how we get the flush eventually in S&Ps to 3,200 or so. So, that's the next narrative is
Yeah.
did the
I
Fed
look,
tighten too much.
people don't like to buy things when companies aren't making money, right?
Yeah.
So,
yeah.
I would assume earnings eventually slow down, and
Yeah.
but
But we could still go here in the S&Ps, we could hold and try the August highs, but it's sure taken a long time to get going. If this is a flag, it's starting to get a little extended. So anyway, lots of weakness everywhere. I don't think that the room is long metals either. We've been talking about lower metals for a while. We've been talking about higher yields for a while. Perfect hold on Stelios's breakout line, and the 10-year came right to tagged it. So these lines do mean something sometimes. Oh, that's too long term to show this 2-hour. Look how it came off his line. Look at that after the news.
yeah.
So yeah, real nice technical line.
It was a crazy move yesterday. What did the team make of that CPI data? Because we got this super hot print, and I know there's recalculations of the numbers, and I'm sure Ryan and KMan and Stelios probably did a deep dive on it today on the flow show. And actually, Stelios, you wrote a blog post on the inflation data. So why did we get the reaction that we did yesterday?
Still, you want to take that one?
Who are you asking me?
Well, we can start with Stelios. He wrote a blog post on it yesterday.
He's nodded off again, I think.
Oh, he might not be here. Man, Ryan, what do you guys think?
Yeah, it's a bit of a bonkers reaction. It was all over the place. The yields dropped, yields rallied, dollar went down, dollar went up, dollar went down again. I know you guys had your sniper rifles out to great effect just now. I ended up doing nothing. By the time I'd finished looking around everything, it'd all gone and it all moved on. But the overriding theme is obviously that the dollar is stronger coming into today. Yields are keeping their bid. Yields are keeping their rise in place. 2-year yields are pushing up again today. That's your short-term look at the Fed ceiling. The market is getting round to where the Fed are taking rates. They didn't believe it was getting up to 5%. Now they're thinking 5.5. Deutsche Bank revised its forecast up by 50 pips. They think the bank rate's going to 5.6% from 5.1. 2 more hikes, June, July. As I said on the flow show 2 weeks ago, you couldn't buy a bid in the dollar, and we were pricing in rate cuts. Now everyone's gone the other way, run to the other side of the boat. And that's what we're dealing with at the moment. The data's looking better, but you suddenly get a bad retail sales today, bad PPI, a bad NFP or other data turning. We've got Empire State again today. If that comes in worse, suddenly the light switch might change again, and Deutsche Bank have to eat their words and start pricing in cuts. So we're in that period where the data is important. We need to see trends developing in this data. Inflation still went down yesterday. That's the trend that's been in place for 7-8 months, and we shouldn't forget that. Just because it slowed doesn't mean it's not still going the same way of the trend. If it starts going the other way, well, then you've got a different picture on your hands.
Yeah. And do you feel like this? Well, you guys saw the UK inflation data. It came in weaker than expected. What do you make of that? Because I was actually just talking to Dick Matthews of Partis FX yesterday, and he was just like, he's like, yeah, I'm expecting a super hot print, and then we got what we got.
Yeah, I've been saying it for a while, as you know. Yeah, inflation's come down. It came down a bit more than expected, but these numbers are going to be used by phone companies, TV companies, broadband companies to hike prices in April and May by 4% over what the CPI and retail price index were. So you're talking 14 to 18% price hikes coming in April and May for anyone who uses a phone, broadband, and TV services. Okay, tell me that's going to cause inflation to drop.
Yeah, and I think a lot of people that are not in the markets have this like this idea of inflation. When prices go up, they'll come back down again, right? Like so when you see the price of let's say your telephone bill that you're discussing, when it's going up at 14% rate, when inflation subsides, it's going to come down. But that the inflation rate that we're looking at is really the rise of prices, not so much the decline of prices, right?
Yeah.
So I mean that's the real problem when I think consumers don't really understand that, because we haven't seen it as a consumer. We haven't seen it in 50 years or 40 some odd years. Gains in inflation like this, that no one really understands that concept anymore.
And what you got to remember is that the headline inflation number you're seeing dropping, that's been dropping for the last 7-8 months, is coming from price rises that happened 8-9 months before that. It's a lagging effect. So, we could say, energy prices have dropped and things like that for the UK, but still prices are going to go up domestically, like for your domestic stuff. And that's going to impact the core numbers. That's why the central banks do a switcheroo between talking about the headline and talking about the core number.
Dale, do you mind if I take the screen here?
Grab a buddy.
Guys, hey, morning.
Oh no, he's here now. We were begging for you earlier, and you weren't here.
I missed 2 or 3 minutes. I had the delivery at home. Sorry. One thing I want to point out: one of the biggest components, if not the biggest components, of the US CPI was housing, rental, right? All that, and this is something that theoretically, with rates going higher, we should see a reversal of that. I mean, obviously it lags the rate hikes, because it's not like the Fed hikes 75 basis points and the market corrects straight away. This is a lagging thing, but we've seen housing being a huge part of the CPI print. Of course, the other big part was food. Eggs, I'm sure in the US are as valuable as diamonds now. But all I'm saying is that the housing part of it really should start subsiding in the coming months. Just something to keep in mind.
Yeah, well, definitely is cooling here in the US. Stelios, when I was asking a little bit earlier, and you must have stepped away from your computer at that point.
Yeah.
We were talking about the CPI and the price action yesterday, and what did you make of it with your blog? Now, before you answer that, I was just showing everybody, this is the ForexAnalytix community. You guys can see this is like this is the chatting that's going on just this morning. In our chat room, but there's a Chi had written in, it's just annoying to hear how Fed and central banks cause inflation. It was pandemic. Sure, the latter was that what broke the camel's back, but you can't tell me that free money all over the world doesn't cause inflation. And it's very true. I mean, it's not just, it wasn't the pandemic and shipping delays and productivity stopping. It was central banks just adding massive amounts of liquidity, and this combined is what's really caused this spike in inflation globally. It's not just the pandemic. It was the Fed and other central banks that really added they're the ones that really kicked it off. And I strongly disagree with anybody that would argue otherwise. So anyway,
Yeah,
but
I
those are
agree
the
with that
types.
too.
I just wanted to point this out. This is the kind of conversations that we have inside of our chat room, not to mention like the charts that we're all looking at, the setups that we're looking at, the breakdowns, the breakouts. You know, this is everything that you can see just in the general chat room. So that's what we do in ForexAnalytix in the community, just for so you all know. But what did you say in your blog? I mean, I know I don't want you to give it away. I want people to go back and read, and I'll put the blog post while you're talking. I'll put the blog post in the chat box for everybody to read. It's free. It's right on our blog. So pass it to everybody. Go ahead. What did you make of yesterday's move?
Well, it wasn't a very lengthy piece, but my main takeaway is that yesterday's number is enough to be I don't want to say game changer, but to make a difference in the short term. So I've talked about how the Fed and the market have been playing, they've been on a tug of war for a while. At some point, something's got to give. I think now that the market has to accept that the Fed, given this inflation and obviously given jobs doing really well, that the Fed simply cannot go into cutting as quickly as the market still expects. Now, how far will they hike from here? The market's pricing just under 75, just under 3 more 25 base point cuts, hikes. Yeah, could be reasonable, maybe a touch more, but the question is how quickly do they go into cutting? And I think that this is what the market now has to reprice. So I think the next move is in yields to go a little bit higher. So, you know, 5-year, 10-year, I think they really have to go a bit higher. And if they do go higher, then we should finally see a bit of a correction in equities, which have been very, very resilient so far.
I mean, you look at the bond market, like here's a 10-year. We had bearish engulfing patterns in the 10-year. You look at Boons. Boons had very similar move. You know, bearish outside day. I mean, yields look like they're going to rip globally. I mean, that's got to affect equities at some point, right? You would think that, you know, as equities at these elevated levels are going to eventually roll over. I mean, that would be conventional wisdom. I mean, what do you guys think about that?
Eventually keyword, because in 87, you would not have believed the disintermediation between rates rising with a falling dollar and the market continuing to go up for months before the crash of 87. So the market could fight rates for a while, but then it's like that last snowflake. Then all of a sudden rates are a problem.
Well,
I think that happens
in
1987.
I was listening to Duran, and I was in high school. So
yeah, well, I'm the historian here. So I mean, that's the example of that rates, the market could fight higher rates and resist declining for a while. And I think that level is 4%, where it won't ignore it anymore.
Interesting. Well, hey, you know, we haven't heard from KMan yet. KMan, what I know you're recovering, and it's nice to hear that you're feeling a little bit better. What are your thoughts about yesterday's price action? I mean,
I didn't understand that 8-10 BPs moved down in yields, and actually after the fact, I was actually thinking it may have been somebody doing a fat finger there on the numbers, because it didn't warrant this kind of setback anyway. But I think the dollar, we are in the repricing mode, and it's probably going not well. I mean, dollar yen is quite a bit higher, sterling is quite a bit higher, but also because what's happening in the other side of the dollar pair, right? But I'm still constructive on the dollar. I do think as well that if data, and we may already know in 10 minutes how it's going to go, and then in another hour with those production data and the retail sales. But I'm still constructive on the dollar. I do think as well that if data hold up, then the longer end of the curve should also correct more, like Stelios is saying. But it could be an uneven move for the dollar. So either you have to choose your dollar wisely, for one, and then for two, it could be uneven, because for the time being, the structure, how this is trading, and I've been saying it already a couple of times, we're still trading a soft or no landing. That means that correlations with equities, and the dollar could make the dollar move higher, uneven. It could be that when stocks are actually holding up better than we think, until we reach that inflection point that Dale is talking about, where too high rates is too much for those equity markets, and then it will come down. They could hang around here for a while longer, I think.
Okay, well,
that's what I mean. I prefer to be long dollars than short equities right now.
Yeah, okay. And well,
Yeah,
where's your favorite way to be long, long dollars?
I think dollar yen is still a candidate.
It's breaking out, right?
Yeah, we're above 133. That's constructive. Next big hurdle, I think, is going to be 134.5 and 135 if we get there. And the other one is likely to be cable, or perhaps a dollar rand or so, but then you have to look for it in the emerging market sphere. If equities will start to come off, then stuff like the emerging markets will likely suffer a bit. Actually, your dollar max is holding very well around 1850. I mean, that may be a part of the reason as well. So yeah, it's
if you're in the chat room, if you're in the chat room, in the ForexAnalytix chat room, I just took my dollar Mexican peso off just now for a loss. Actually, I've been sitting in it for a week, paying interest on it too, and I just took it off for a small loss. Just kind of got it out of it. It's been a very frustrating trade trying to be on the long side. My average was not too far away from where we're at, but I was paying every night to hold that sucker. Yeah. It hurts.
Yeah. And then have a look at dollar rand. That stuff looks to be very close of breaking out as well, right?
Yeah,
right above here, 1805.06. I've got some resistance there. But no, I think as Ueda in Japan is not really giving the hawks too much food right here and now. It may change in 10 days after the hearings, the parliament hearings, but I'd say dollar yen, if US yields continue to rise, dollar yen is going to copy that, and we're likely traded a bit higher.
So I've been looking for a move in the dollar yen towards the 135, towards the as we get closer to the 200-day moving average, to play it on the I wanted to play yen on the long side. But we still have less than a month, but we have a couple weeks till we find out who the new BOJ governor is going to be. There's a lot of people getting the nod, but ultimately I still think we could get a move higher. What do you think?
Yeah, I don't think there's going to be any surprise. It seems that Ueda and his two companions, deputy governors, will get the nod on the 24th. I don't see too much of a struggle to get through. So
how do you pronounce his last name?
Ueda.
I forget how do you spell it. Whatever, doesn't really matter.
Yeah. And
we'll all figure it out over the course of the next few weeks, I guess. Hey, let me ask the team this. We got retail sales today. We're going to be covering that live. We got Mr. Mark Chandler from Bannockburn. Dale, you always bring Mark in at such a great time. He'll probably be able to break down this.
That's because any day he's here is a great time.
Yeah, I have Mark here. I think I've got a library of his books behind me. He's a really, really great resource to have around here. But we have retail sales today. Producer prices tomorrow. How important are the producer prices tomorrow for us to factor in, inflation moving forward? What are your thoughts there, Ryan?
Yeah, they're going to be important because we saw the CPI. If we get a steep drop in PPI, that would suggest that inflation is still going to track lower, because PPI is probably more a bit of a leader than CPI. It can be quite volatile. So yeah, again, it can flip things around. If PPI comes in hot, that's going to add to what we see now. Yields up, dollar up. But if it comes in really, massively lower, it's going to take some of the wind out of what we're seeing at the moment.
Yeah, very, very true. Stelios, what did you mention that in your blog as well?
Sorry, which thing?
We have PPI tomorrow.
No, I didn't. No.
Oh, okay.
For me, I've said it before. For me, the main number was yesterday's number. Obviously everything counts, but for me that was the far and away the most important number. So I did not mention that. No, maybe I should go in and amend the blog. No.
Herja said, if you were dollar index bull, then I don't quite understand why the ForexAnalytix analysts will not play it by shorting the euro US dollar. That's a good question. You know, I'm not necessarily a euro bear. I think that the euro is trying to roll over. It hasn't broken down yet. So I need a little bit of convincing, but if you haven't taken a look around, you should actually take a look at some of the cross rates. I don't know if you've seen this, but the euro Aussie, excuse me, is nearing wedge resistance. The euro Kiwi, wedge resistance. Euro sterling is bouncing off of really key support. So if you're shorting the euro right now, you're fighting cross rate currents. So why don't you focus on a currency pair that is more vulnerable versus the one that's actually strengthening against other currencies? You guys have any thoughts on that?
Yeah,
that's exactly what I've been saying for a while. Unless you're in a very high high interest rate carry trade, which I am in, but the rest of the euro crosses are rather long. So if my bias is to be long some euro crosses, it's hard for me to be short euro dollar. But I'm long dollar yen, and I can be short cable and whatever. So it's just choice.
We can hear you.
We can hear you, Dale.
Okay. That's
yeah, we're just ignoring you, Dale.
That's what it is. Oh God. All right.
So, hey, Steve, good to see you. We actually are good to hear you. We got and by the way, I actually think the euro will break down. I just think you're going to have better opportunities with like the Aussie. You're going to have like the Kiwi we talked about yesterday. It was, you know, nearing channel support. Look, we've got a breakdown happening here. That you could see a really big, you get a little risk off, you know, the move that you would see in a commodity currency like the Kiwi might be much more aggressive than what you would see in the euro. I do think the euro can pull back to, you know, 104, maybe the 200-day moving average. I just think you're going to see more pronounced move in other markets. What's that, Brian?
You get more bang for your buck.
Yeah, absolutely.
The others that you might get in euro dollar. You know, that thing can move 40 pips and be done for the day.
Right.
So it's trade selection.
Yeah, it is. Not every currency is created equal when you're talking about dollars, and especially in a move where you might see the dollar index move up as a whole, but the euro might not participate as much as like I look at this big double top in this sterling. I know we talked a lot about it, you know, for the last few weeks. Look, if this thing breaks down, I mean, we're going to see 112, you know, and the euro might, you know, make it to 102. I mean, and that would put the euro sterling would you look at a currency like this, and if that happens, you know, euro sterling would be trading back well above, you know, new trend highs above 90 pence. So I have a more difficult time trading the euro on the short side when, you know, you could have potentially bigger moves elsewhere. Anyway, we got about 2 minutes or a minute and a half ahead of the data. Steve, I'm sorry. What you've been listening in probably. What are your thoughts about CPI yesterday? Anything that you want to bestow on the listeners here?
Nothing that has really changed. The initial reaction to the number was weird. That's why I never trusted it. And I said immediately that, in my opinion, that's a buying opportunity for the dollar. And it
was a great call, by the way. You were here live yesterday. You're like, I would be buying dollars on this dip, and it worked out. Worked out really well. So,
and I think we're not done yet. I think that there is a very high probability that we're going to see a continuation. Probably even today.
Well, let's you know, here's the dollar index on a 15-minute chart. You can see that happening. Here's the S&P 15-minute chart over here. We're going to put yields. We'll just put the 10-year yield, kind of see what yields do following this retail sales data. It's hard to bet against the U.S. consumer. I always find it very difficult. We'll find money to spend, you know, we'll spend it, hell or high water. So, but it'll be interesting to see if the retail sales and consumers is holding up in this, very high inflationary environment. So let's see. Here comes the data. Wow, S&P is dumping. Woo, woo, woo. Whoa,
minus
whoa,
1.5.
Empire
On the
State
California.
Manufacturing. That was
Yeah.
a really big improvement. Did you guys see the retail sales numbers yet?
No.
Okay, that Empire
3%
State Manufacturing.
apparently, 3% or so. I hear 3% somewhere.
Wow, 3%. I saw it too. I saw
That's
it 3%, and the dollar is ripping.
Yep.
So
all this tightening and the economy is still strong. The consumer still has jobs, and the market could handle rates going up, and so can the consumer.
yeah, it looks like
don't
looks
jump
like,
the gun, but because eventually there is going to be
That's the art of it.
the effects of hiking are going to be eventually there. I remind you that
Yeah.
people don't realize that frequently. Even central bankers themselves say it all the time. The effects of monetary policy have a substantial lag, right?
Yeah. The art of it is always the when.
Yeah, exactly.
so just you guys can see like some of the patterns in play that have been developing that the teams identified. We've got some moves that are actually brewing here in the markets. As a ForexAnalytix subscriber, you guys can see those. So anyway, I know Mark Chandler is going to be here. I want to say, guys, is he here?
Yeah, he's there.
Oh, he is here. Good. Well,
Yeah.
I always love to have Mark here. He's such a just amazing source of information and in the currency market. And I want to say, Ryan, KMan, Steve, Stelios, great job today, yesterday. Great coverage. Remember, tomorrow we got producer prices. We will be here live tomorrow covering PPI as it's being released. Dale, have a great interview with Mr. Mark Chandler. I love that guy. Right. And thanks everybody. We'll see you tomorrow.
Who likes the background? Give me a Y.
Yay! I love the background, Dale. Looks great.
It is amazing.
You look handsome.
Right, so God, it's great.
Handsome devil.
Brings out the gray in your hair. I'm kidding.
The silver still.
Silver, yeah,
silver fox.
Yeah, all right. So Mark, God, it's been a long time and great to have you here with the dollar rebounding. How are you, buddy?
Good, surviving. That's the best we could hope for.
Okay, well, in that survival, I hope you find some joy in between. We don't want to be Mad Max yet. We don't have to be yet. But what's top of mind on this dollar rebound, Mark? Is there anything that you feel it's going to be short-lived, long-lasting? What do you think?
Yeah, so I think that, we had such a big dollar pullback in the last 4 months. That's September, October, November, December. Actually, the dollar topped out end of September, early October, and we fall in the next 4 months. And I've been looking for this, for the dollar to rebound. And what took the dollar to rebound, I think, was a change in fundamentals. And that is the pendulum of market sentiment has swung from Fed funds peaking below 5% to Fed funds maybe peaking closer to 5.5%. And so I think that this has given the dollar sort of the fundamental reason to correct higher. And I think it's got some more legs like the team spoke about. I'm thinking that still in the early stages yet. We have to really get through this 106.5 area on the euro, which I think we might today. And I think we might go down to maybe 104.5 or so. A key retracement of the big rally that the euro had off those September lows. I think this is fundamentally based. And but to your point, I'm not convinced it's going to last very long, in the sense that I sort of share what I think it was Stephen said about the about monetary policy taking place, impact with lags. And so I think that we had a horrible end to last year. You talk about American consumers, retail sales fell by more than 1%. Well, it looks like with the revisions, fell more than 1% November and December, and the economy generally weakened. And I'm thinking that we just get this the reprieve, but the real test will come in Q2 and Q3. And the same thing for industrial production out shortly. In November and December, manufacturing output fell by more than 1%. So we'll get the bounce back here at the start of the year, but whether it can be sustained is a different question. I'm thinking that this is a one-quarter recovery of the economy before the real challenge in Q2 and Q3.
Okay, so the narrative will shift from rates to economic weakness, which could, have people worrying more about a recession again. I mean, now people are saying no landing. Yesterday we went from hard landing, soft landing, no landing. So the airplane is going to need some fuel if it's not going to land. Where's that going to come from? The consumer already
I think you're right.
has their credit cards maxed. Their cards are maxed now, Mark.
Yeah, I mean, I think that partly also, it's not just say relatively good things happening here in the States for the economy, the bounce back that we're seeing, both CPI stronger, retail sales stronger. We'll get a strong industrial production number shortly, but also the tail risks have been reduced in Europe. People were worried about a recession. They're no longer worried about a recession. It always scares me when I sort of see market sentiment psychology talking about no landing or somehow we repeal the business cycle. I don't believe that. I think that's just part of the mentality we need to justify the risk taking that we're taking on. Still the honeymoon's going on that began the year. I think that you see this in a lot of risk-taking moves, even though the U.S. stock market struggled recently. I'm looking at other markets which have recouped a good part of last year's losses. You guys are talking about Mexico. Peso's been red hot, and it's not just flows into the stock market. It's a nice carry trade, and as you can see from the press coverage, foreign direct investors, that is businesses locating production, distribution in Mexico, get inside the USMCA tariff walls, the domestic content, including Chinese companies. So Mexico is really an interesting story. The currency just tested 4.5-year highs yesterday. We're bouncing off that in light of the raw dollar strength here today. But I think the peso still has legs to go. I'm looking at 18. We tested that 18.50 level, like you guys mentioned. I think we can go back down to 18, even on that, and that would bring us back to where we were in like 2018 or so.
Okay, so a lot of people, Mark, piled into the EM trade 2-3 weeks ago while the dollar was under pressure, and the EM has been underperforming. Is that a function of the dollar rally? And that eventually they're going to be right about outperformance in other markets outside of the U.S.?
Yeah, I think so. I think that, like the raw dollar, we've seen the correction in some of the EM. I think that, so one has to really decide really whether this is really a trend change. And a lot of the companies that I talk to these days, they basically have to put dollars into Mexico. And so they're converting dollars into pesos, pay for call centers, pay for manufacturing. And I think that will keep the peso relatively a healthy performer here. And remember the carry. I think Blake was talking about having to pay the carry when he's trying to go long the dollar. I figure that the cost of hedging is almost 1% now. And a little rule of thumb here that you can do, a tool that you can have, is that I look at the forward points as a percentage of the spot price, and that tells me what it costs to hedge. And putting this in perspective for you, to hedge the Canadian dollar is about 1/4%, and to hedge the peso costs you about 1%.
Yeah, big difference. I want to switch gears a little bit and talk about the Bank of Canada was the first to raise rates. They're the first to pause. And do you think that the pause is going to be different in countries that have variable mortgages? A larger percentage of Canadian households are on variables. So their monthly cost on their mortgage has gone up dramatically compared to the US, where most people are locked in at 3 or so. And this interest rate increase hasn't reduced their liquidity because they're not in variables. That didn't happen in the US like it did in Australia, I believe the UK and Canada.
Yeah, I think you raise a good point. And broadly, I think it's really how the interest rate increases filter through the economy and how the US household for mortgages is fairly well protected with these 30-year fixed rate mortgages. On the other hand, I'm not really convinced that the Bank of Canada is going to be able to pause for long. You saw those jobs data, just like mind-blowing strong, just like U.S. data. But put this in perspective. Canada added about 150,000 jobs in January. The U.S. economy is about 11 times bigger.
Right.
So imagine if we would have got not just a print of 500,000, but a print of over 1 million.
5 million. Yeah. Right.
You know, and so
yeah.
So my sense is that the market not only has the market come around and converged with the Fed as far as expectations, but the market is now saying that the Bank of Canada's pause might last this quarter, which means that the next batch of data might not be that important, but they'll probably raise rates again in Q2. And there's just another 25 basis points, but more broadly, I think that you're right that the many of the say the G10 banks, G10 central banks are likely to pause sometime, whether it is Q2 or Q3. That end of the monetary cycle, I think we can count on this year. And I think that's going to help us in the second half of the year, encourage risk taking, even if the economy weakens.
Interesting. So, okay. So if we're going to have one more capitulation move in the market, say, for example, let's take the S&P's, Mark, that if it's going to happen, it should happen before that, or it's not going to happen at all. That if we're going to get one more wave down in the market to challenge October lows or take them out, that it should happen before the third quarter. Is that what I'm hearing you say?
Yeah, I think that so to your point, I think that what I really like about the markets is that one way to conceive of them is they're a huge anticipatory discounting mechanism. We don't always get it right, of course, but I know that there's some people said the market has no clue where Fed funds are going to top. Of course, the market's got a clue. We know within a certain range with certain confidence, and I think that's generally true that the markets tend to lead. So we should look for the stock market to bottom before we really get the before the Fed is done. The market's going to anticipate the end of the Fed tightening, and it's getting a bit fuzzy, of course, whether it happens in Q2 or early Q3. But I think the market's now leaning much more aggressively, and so I think it leaves us vulnerable then when news does not repeat what we've seen in January, whether it's today's retail sales, the jobs data. I mean, it's hard to imagine the U.S. creating 500,000 jobs a month for the rest of this year, or for the next several months, even for the next month even. And so I think that the pendulum of market sentiment has swung, and I think this talk of no landing, it just tells me how far it's swung, and that we're going to be swinging back before the end of the quarter.
Okay. Looking at 10-year yields, Mark, we had a trend break this week, and really the inflection point was the employment number last Friday. That's when everything began to be repriced. And do you think that we have a chance to make new highs in yields over 433 in the coming months?
Yeah, my guess is we don't make new highs even if we approach them. The more aggressive the Fed is now, the more people are going to be convinced, I think, that we still headed toward recession. That rather than this recession being an inventory cycle or something like that, I think people will begin looking for the fingerprints of the business cycle's murder at the Federal Reserve. That is to say, many people suspect that the Federal Reserve often kills expansions by over-tightening. And I think the more the Fed tightens now, I think this is why the yield curve is so inverted. The market says, yeah, the Federal raise rates in the short term, so the 2-year yield jumps, but the 10-year yield is still lagging far behind. Yield curve very steep, and even the curve that Powell has talked about, which is a 3-month rate, 18-month forward. And I know it sounds kind of complicated, but we look that money market curve is also inverted, and Powell himself has said that this is a good indicator of recession.
Okay. Don't you think it's a big problem for the Fed, where two of the biggest areas that they want to see price declines in, for example, housing, and although rates are going up, they're tightening into a housing shortage. There's not enough housing stock, makes their job that much more difficult to get the cost of housing down. And then they want to take unemployment up with a secular labor shortage. So their two biggest battlefronts, they're fighting shortages. there aren't surpluses of homes, or we'd probably see prices reflect it more dramatically. And there's a shortage of laborers after COVID that aren't coming back. So how effective and how much does the Fed have to go? Could that lead to overkill if the Fed is still targeting housing and labor?
Yeah, no, I think you're right. I think that those are the big issues. I would say though that with mortgage rates coming off almost 100 basis points in the next over the next few days into next week, we're likely to see some better data from the housing market. So housing starts likely to be weak. They're out, I think, tomorrow. Permits though could rise for the first time in a few months. And next week we're going to get existing home sales, and they have fallen every month since last January. And they're likely to pick up as well. So my sense would be something like this. Housing market sort of led into, with the higher interest rates beginning last year, housing market took the brunt of that. And we're likely to see some stability coming in. And the Federal Reserve uses, the BLS for the CPI calculation uses a dated type of backward-looking assessment of house prices, shelter costs, and I think that we'll see those begin moving lower around the middle of the year. So in some ways, what we're talking about is the first leg down in US CPI was fueled by the drop in goods prices, right. And this next leg will probably be carried by service prices. And for me, the key still is that the base effect, and a lot of people don't fully appreciate it, I think, that in the first half of last year, US CPI rose by at an annualized rate of a bit more than 10%. And that's those numbers are going to drop out, including like 1.2% month over month gain we saw early last year. Those drop out. I think that CPI comes down. And I know you're talking about PPI before, and that's out tomorrow. And I think that, many of us have in our minds this pipeline effect where producer prices go up and then consumer prices go up. But the markets, and not just the financial markets, but the markets for goods is much more efficient than that. We don't have to wait for a gasoline price for the gas station to use up its old oil before it puts in the new oil, right? And so I think that, to me, the real key for consumer prices is not about producer prices. Producer prices, you think about what consumers buy. Here in the U.S., we buy a lot of services, more services than goods, typically, leaving aside the COVID experience. And I think that that's what we should be looking for inflation, is not from the PPI, but from services. And this is, of course, the big thing that Powell keeps talking about. Services, core services, excluding housing, just get the real signal. And that softened last month, rising only 0.3%. So I think we're still in a good position for inflation to fall, especially here in the first half this year. And I think that that'll also take some pressure off the Federal Reserve. So the market might be overshooting here, talking about 5.5% or 6%. And instead, I think that the Fed, the December dot plots pointed at 5.25. I think that's where the Fed sticks at.
Okay, your view on U.S. dollar yen, Mark? Just like the dollar recovering, is this a bear market rally? And do you think what kind of levels are you looking at in U.S. dollar?
Yeah, last week I was talking about 133. We're through that now. For me, the key level is 135. I think someone mentioned that before as well. The 130, we haven't traded above 135 since the December surprise. That also gives us a nice retracement level. So I do think that that the Japanese Prime Minister's first choice was for continuity of policy. And when the first candidate, Amamiya, turned it down and recommended Ueda, I think that that also really speaks to continuity. And what I'd be looking for there is not a change in policy so much as just some kind of game plan of sequence. There's so many moving pieces. The Japanese extraordinary monetary policy, you got the yield curve control, you've got the center of that yield curve control at 0. So they allow it to move 50 basis points either side. They could move that. The Bank of Japan is also the last of the central banks with a negative policy rate. A small adjustment to that. They're buying a lot. I mean, as the Federal Reserve and the ECB's balance sheet shrinks, the BOJ's balance sheet is expanding even faster. And so there's a lot of room for the BOJ to tweak policy. But in general, I think that the first step is sequencing the exit strategy. Not that they're going to exit, but they just sequence it. What should come first? Should they raise rates before they stop QE? How does it play out? And so I think that in this context of rising U.S. interest rates, especially at the short end right now, I think that the dollar yen could test that 135, maybe even go a little bit above it. I'm surprised if we get to that 140 level you have on the charts.
Okay. All right. And the commodity currencies, why don't we just go with Aussie? Had a nice recovery in a pullback phase here. You have any levels in Aussie that would be attractive longs for you, Mark?
Well, yeah. So I think that we've had this first leg up, like you'd see on the charts from October, a big rally. We sort of stuck. Even yesterday, we couldn't really get above that. We couldn't sustain a move above 70 cents. That's important. There's some options expiring there today. So I'd be looking for a move back to maybe it's 66, maybe it's a little bit lower. But I think that what we're going to do is correct this first big leg up that the Aussie had. More broadly, I'm looking at the 50 and 200-day moving averages of all the G10 currencies crossing except the Canadian dollar. And so I think that in my mind, that helps confirm the idea that the US dollar put in an important high last year. And so the move that I've seen up in the dollar now, I'm sort of viewing it as corrective in nature and looking at the same kind of things that, that we all talk about, Fibonacci retracements, 200-day moving average, these kind of things, just to give us some sense. It's sort of like mile markers on the highway. It's not necessarily support or resistance, but gives us some sense of the magnitude of the move that we could be expecting.
Okay. So takeaway I'm getting, Mark, is this is a bear market rally in the dollar. There could be more left, but the major trend shifted last year, and maybe the trade just got too crowded.
Yeah, I think so. And it's funny that you say that too about trade being too crowded. I've been watching the what's euphemistically called non-commercials speculators in the futures market, and they still have a relatively large long euro position. And so I think it's one of the only currencies, futures, that the market has really gone long on in a significant way. And so, yeah, I think that a lot of the good news for Europe, the reduction of the tail risk, the reopening of China, priced in. What I noticed was that the index of Chinese stocks that trade in Hong Kong are now off about 10% from the late January highs. And so I think that's just another sign to me that swinging the market pendulum, a lot of good news priced in, the reduction of that left-hand tail risk of bad things happening. And so I think that this has a little bit more room to play, but all it's going to do is take a weak U.S. jobs number, a softer CPI number next month, and we're back to what kind of landing we're going to have. It's going to be a landing. It's just a question of how hard.
Well, it looks like copper is on its way to declining into some type of landing. And I have to, this whole rally in copper was the reopening trade in China. So we're, testing the breakout too many times in my view. It tests it once. Okay, Dale, you missed the first entry. I'll give you another chance here. Oh, you missed the entry. I'll let you buy it here. Mr. Market is making it a little bit too convenient to trade this breakout. What do you think the implications are for copper turning south now when everyone is so bullish the China reopening?
Well, yeah, I think that this bullishness towards China really peaked while they were on holiday for that Lunar New Year. Yeah. And I think once they reopened, sort of reality's coming back. And, I worry that America is getting more and more mentally on war footing. We saw with the balloons and that whole drama. And I just sort of think that we saw last year that Chinese population growth is shrinking. The demographics are horrible. They still have talking about over half the population living on like less than $10 a day or something like that. And so to me, China, like other threats that America partly sort of blows way out of proportion. I think, China wants to change the global economy in its favor. No, it's not going to succeed. And I think that it scares me about this war footing. We see China as the cause of all of our problems, when to me, our problems are really homegrown. I mean, we all know what the U.S. problems are, whether it's the disparity of wealth and income, whether it's the young people committing suicide, whether it's longevity in the U.S. Isn't that the ultimate measure? How long do your people live for? And
Yeah.
in the US, it's falling and falling more than in other industrialized countries. And so I don't think these problems have a cause in Beijing or Moscow. I think they're homegrown. And what worries me is that we keep externalizing our problems. Even with CPI, people say, well, China's reopening. That's going to cause U.S. inflation to rise. Really?
Yes.
Medical costs in the U.S. are tied to China? I don't think so.
Yeah.
Shelter
Yeah.
costs tied to China? I don't think so.
What a great point, Mark. And, you know, something for people to keep in mind, because you have to be skeptical when Republicans and Democrats agree on something. And their and their anti-China stance is very universal in Congress. Mark, what a great interview, like usual. I encourage people to go to your Mark to Market and work with you. And, you know, I just think, you know, we're all fans here. Blake's a big fan. He has, you know, all your books, and I have an 8x10 glossy of you in my office, and just really glad that our paths crossed, and appreciate you coming and sharing your insights with our community.
Well, thanks a lot. I appreciate it. And, you know, I really have a lot of respect for you guys. I mean, in the sense that what I've done with most of my career is basically telling sort of OPM, dealing with other people's money. But when I can have a lot of respect for people who have skin in the game. That's what I learned when I was my tenure at Brown Brothers Partnership Bank. People who have money in their skin in the game makes a big difference, and I can have a lot of respect for that. So good luck to everybody.
Well, you're the kind of guy that we bring your views into our assessments, which gives us more conviction about assuming risk. So thank you, Mark. My trading warrior brother, Mark Chandler, everybody.
Thank you very much.
Follow Mark at Mark Making Sense on Twitter. Go to his website, Mark Making Sense, like he did today. Adios, buddy.
Thank you. Bye-bye.
All right. So that's a wrap, everyone. Hope you enjoyed it. I love talking to Mark. I learn from him every time. And you could join the team in 18 minutes on the Morning Edge. And don't just count your pips, count your blessings. Adios.